With only 15 trading days left on the calendar, I have $900 that I need to invest before the beginning of 2023. Of the 13 different positions that I hold, I plan on putting this money into just 3 of those companies. Now, this move should add roughly $67 worth of dividends to my annual dividend income, which is roughly on average 7% across those different positions. And oh, do I love adding dividends to my portfolio. Just love it. For those of you who don't know me, my name is Steve Coleman, and I put $150 and sometimes more into my tax-free savings account so I can buy some Canadian dividend companies. I'm a huge fan of the dividends because I'm growing them to be a source of passive income when I eventually retire. But in the meanwhile, we are still in that accumulation phase, so we're going to talk about the 3 different companies I plan on buying. As I mentioned in the beginning of the video, these are all companies I already own, so I'm familiar with them already. This is not financial advice, so please do your own research, look into the companies, see if they're right for you. With that said, let's keep going. Let's cha-ching. The first company is Bell Canada, ticker symbol BCE. I actually started buying a little bit more of Bell Canada at the beginning of November, so I'm currently up to a total of 21 shares. I originally started buying them because I'm a Bell Canada customer and I wanted them to be paying me instead of me always paying them. When you look at the fundamentals of this company, they're pretty solid. They've been around for a very long time and they're not going anywhere. From a dividend perspective, they are on the Dividend Aristocrat list, meaning that they have been increasing their dividend consecutively for at least 5 years. And that is one of the things I'm after. I plan on buying 6 shares of BCE before the end of the year, which will add $22 to my annual dividend income. Currently, I'm getting $77 from that company, so that puts me very, very close to hitting that $100 mark, which is kind of cool. These purchases won't really affect my average buying price because I'm currently only within 1% of the current stock price. So this is purely for the dividends to get them over 100 or close to more than anything else. The second company I plan on picking up before the end of the year is Algonquin Power and Utility. The ticker symbol is AQN. This is a company that has received a lot of attention in the last few weeks. A lot of YouTube videos have been made about this company ever since they released their quarterly results. In those results, we saw that they are taking on a lot of debt. We're talking $7 billion. Now that news caused their stock price to drop 30%. When we look at their debt equity ratio, it is currently 110%. So we need to put this in perspective of some other companies in the utility space like Enbridge. And their debt to equity ratio is 121%. And when you look at Interject Renewables, another company I own, their debt to equity ratio is 345%. Looking at those numbers, it's hard to tell what all the fuss is about when one's 300 and one's just 100, but it's what type of debt, and it's because Algonquin's debt is all tied up with variable interest rates. So it is very much at the mercy of the interest rates going up and then their interest payments being that much higher, which causes a whole lot of instability, which investors don't like. This is, of course, something that you should be concerned about if you're only planning on holding this company for the short term. Because of those variable interest rates, they're going to eat away at the profitability of this company. But if you are investing in the long term and you can see that this company is producing a lot of revenue and eventually those profits are going to come as their debts get under control, then this makes a perfect buying opportunity, especially when you're buying in at a dividend yield of 9%. I plan on buying 24 additional shares of AQN, bringing in an additional $23.50 to my annual dividend income. This will now make AQN my highest paying dividend stock, bringing in roughly $35 a quarter or $141 total for the year. The argument could be made that they could potentially cut their dividends because of the situation that they're in. And that would certainly suck. Now, I'm not too worried about this because when I look at my portfolio, they only represent 5.5% of the total. So if they did cut anything, I really don't think I'm gonna notice, which that in itself is a strong argument for why you want to diversify your portfolio. And lastly, I plan on investing more into Aecon Group, ticker symbol ARE. Now, unlike Algonquin, who experienced a sudden price drop, Aecon has been experiencing a price drop over the last year. It's dropped year to date 41%. In my portfolio, that's roughly 30% that I've seen it drop. So why am I investing in Aecon? This is a pure and simple dollar cost averaging opportunity, and as well as to take advantage of their high dividend yield of 7%. Now, I fully expect that price to go back up. This is a company that keeps on bringing in new business. Their revenue is high. It's just the profitability has not been right on. In their press release, the CEO was quoted as saying, Aecon continues to see strong demand for its services across Canada, particularly in smaller and medium-sized projects. And seeing as I'm sticking around with this company for the long term, it's going to be my portfolio for a long while. I'm adding 30 additional shares, which will add $22 additional in dividend income to grow that passive income. Now, it's best case scenario that all these stocks are going to come in around $900. I'm of course at the mercy of the fluctuations in the market, but hopefully any dividends that I receive in the month of December can help make up any difference that may occur with what I plan to buy and what I end up buying. But I invite you to subscribe and follow along as I'll keep you updated on how much of this plan I can actually execute. Looking back at my spreadsheet, you can see here that the greatest opportunity I really had for some dollar cost averaging was actually with Chorus Entertainment, where I'm currently down 36%, roughly $791. So why would I not be putting my money towards that one? The truth is, I just did do that. And I've got this video here where you can see where I talk about why I'm still investing in Chorus Entertainment, even though they too have recently suffered a major price hit. In the meanwhile, keep in the green, everybody. We'll see you in the next video and take care. Bye.